I tell you what, there's more and more people calling for the perfect dip to buy. And today you saw all the crowd of the buy the dippers cheering for this big gap up. And it wasn't until the FOMC announcement came out, it got a knee-jerk reaction to the upside, which is typical to see. And then it started selling off when he took the podium about 30 minutes later. And then after that point, it really just started selling off until he stepped away from the podium. And then the market started to drift up higher. So volatile market. Volatility is not going anywhere. We're going to talk about that in today's video. You're watching the Stock Market Brief Show. My name is Michael Silva, and the date today is January 26th. Sorry I couldn't bring a video to you yesterday, but we got a lot to cover in today's video. Let's get into it. Welcome back, everybody, to the Stock Market Brief Show. If you haven't done so already, make sure to hit that thumbs up button. Whee! It's greatly appreciated. It's all that I ask. Now, we're looking at a chart of the Dow Jones Industrial Average, and the reason why I'm pointing this out is just to give you an idea of this environment. During times of high volatility, for whatever reason it is, the typical thing to do is try to, one, tag the bottom, or two, try to place bigger trades than what you should be in times of high volatility to make maybe potential losses back. And that right there is just a recipe for disaster, unfortunately. During times of high volatility, you should do what most people don't do. They typically lower their position sizes and they wait for volatility to contract. And then that'll also allow them, by reducing your position size, it'll allow you to expand your stop losses. Now, these type of environments, they're good for intraday traders, all right? Volatility is great for traders intraday. You can see some big profits. And you can see, obviously, big losses if you're not controlling your risk. Now, for swing traders, breakout traders, even investors, during times of high volatility is when you typically see them take their foot off the gas. And the reason why I'm showing you the chart of the Dow Jones Industrial Average is just look at the last 3 days. Okay, this is a 15-minute chart, but we're highlighting day 1, day 2, and day 3. Okay, we're talking about 1,000-point swing on average each day from high to low. Those are huge swings. And with that type of volatility, it's very hard to find a solid position from a good risk to reward standpoint. So during this period of high volatility, what you should not be doing is trying to tag perfect bottoms for either long-term investments or whatever the case may be. During times of high volatility, it's best to kind of just pause and breathe. And I'll show you when that might take place where you can start potentially getting a little aggressive based on my opinion on these lower time frame charts. Okay, so let's continue on. Let's take a look at the VIX. Okay, so the VIX is at a very high level right here. Okay, so the VIX is at 3196, almost 32. All right, up in these ranges, up here, that's where people get chopped up. Okay, that's where people start puking out positions of their long position, like their long, whatever they're long in, as far as their individual stocks or portfolios. When they start to see massive volatility, when it goes against them, they start getting out of those positions. And then two, what you typically see is the uninformed investors, they'll typically try increase their positions to make back some of those losses. All right, and that's where it gets very difficult up in this environment. Now down in these ranges, sub 15, everyone's a professional. All right, so as it stands right now, we're at elevated levels of volatility. It's a time, once again, to be very cautious. And I'll show you what the options market is pricing in momentarily. But it's not just the VIX. Look at the RVX. This is Russell Vol. It's above 35. This is also an area where you just don't want to go all willy-nilly. The IWM looks, honest to me, it looks like it's crashed. Like I think it just hit a bear market today. It's down over 20%. So it's technically considered a bear market. And then you take a look at NASDAQ volatility. That's at 38.1. Volatility is very high, and the higher it stays up here, it's just continuing to trend up. Okay, so like I said, you're starting to see these large swings in the indices. Today, everyone was super excited out of the gates. Even the Bitcoin crowd, everybody was super pumped. Should we get in? Should we go? Should we go? And then all of a sudden, the Fed came out and then took that all away from them. But I got some decent news because we do see some things developing that does look like a capitulation type bottom. But also, on the flip side of that, unfortunately, this is where crashes actually do take place. Now, if you take a look at the dollar perpetuated to the upside today after the announcement. Now, when the dollar flies up, I mean, just look at the correlation. Dollar flew up, S&P 500 broke down. Okay, that's been a pretty strong negative correlation for quite some time now that I've been, bringing up on this show. So the dollar got stronger. It's not like, honestly, it's still going sideways. It's not really going anywhere. So I would say if the dollar does start to hit this wall and start to back off a little bit, I would expect gold to start performing back again. It was down a little bit on the day, and maybe potentially equities to bounce a little bit. But just look at the ranges of these last 3 days. They're huge ranges on the SPX. You take a look at gold. Gold was down 1.23% today. Okay, so the Fed came out, right? You think that maybe potentially gold might start moving up, as a flight to safety. Didn't get it. Where was the flight to safety? It wasn't in bonds. All right. It was a very, very mixed board type of day. And if you take a look at oil, I think I have up. Yeah, I brought up the USO. So oil also up pretty big on the day. I think oil WTIC was up around 2.5%. USO was up 1.16. I'm showing you this one because of that shooting star type candle. I wouldn't mind trying to take a stab at this going positioning short, but the only way I'll do it is if I get confirmation to the downside. But understand this: if you look up like 52-week high list, the 52-week high list on a scanner, you will be flooded with just a bunch of energy names and oil names because they have been absolutely ripping. So you'd be taking a shot at shorting something that's showing the most amount of strength, hoping to get lucky. So when you do, and if you do something like that, make sure that you're managing your risk along the way. Yields, the spread kind of flattened out here a little bit more and a little bit more right there. Not much to report overall. The 10-year was up pretty significantly on the day. I think it was up almost 4%. If you take a look at the heat map, Microsoft reported on earnings. I believe it was Microsoft that reported on earnings. Don't quote me on that. I know Tesla's doing that right now as we speak, or just previously as, I'll bring up a chart here momentarily. But Microsoft was one of the main leaders of the day. NVIDIA was up one of the main leaders of the day. But understand this, NVIDIA was up like almost 6.5% intraday. And until the Fed came out, it dropped down to 2%. So, still managed to hold its gains for the day, but it was up significantly more until the Fed came out and talked. So when you get these big names up, Google up, Microsoft up, you typically see the indices perform a little bit better. They struggle to hold their gains, obviously, today, unfortunately, which we'll get into those here momentarily. But if you take a look at Tesla, look at this, just all over the place after it reported earnings. So you can see, it sold off just like everything else intraday, started rallying towards the end of the day. Earnings came out. We'll see where that finishes overall, but just massive amounts of volatility. What kind of swing is this? You're looking at, around 970, 980 to around 880, so about $100 swing. It's pretty wild there. If you take a look at the SPY, now let's talk about the weekly range that the options market priced in. So first and foremost, just take a look at that gap up. We rallied a little bit higher, all right, and then we just completely collapsed on ourselves. Where are we for where the basically week started? Slightly down, nothing too crazy, but we are slightly down on the week. We're relatively right in the middle, of the range, just slightly down from it. And by the range, I mean what options market priced in. It priced in a move from this point, So it's a pretty large range of volatility that it priced in. And now, it's already Wednesday, so we have 2 more days of trading. And I wanted to just point out this orange line here and this orange line here. It's an $11.5, $11.51, let's call it, move or point move, okay? So volatility was relatively high going into this week, and it's still at the same point, meaning that these range candles expect to see very similar type stuff. Large moves to the upside, large moves to the downside, large moves to the upside. Volatility has yet to subside. Now, we are below that 200-day moving average. The longer we stay down there, it's not as good because typically, I'm sure that there's plenty of traders, investors, algorithms out there that will buy when it's above it. But as it stands right now, it's not, okay? Now, if we take a look at the 15-minute time frame, I wanted to talk about, okay, so when can we start to feel a little bit more confident? Okay, so in very simple terms, so I posted this. This was one of my only posts today on the Discord because I knew today was going to be a very volatile day. The 5-day moving average is still declining. So we're in short-term bearish context. I posted it right here, basically stating that, hey, we're coming into the 5-day period moving average. It's normal to see some selling, which was positive, but it's normal to see some selling out of the gates, and just be basically mindful of that. And as you can see here, the 5-day moving average throughout the day, it would try to get above it, and then it's just sunk off. So what do we need to see? I mean, if you're going to buy the dip when there's some signs of some strength on the chart. So what you want to see is this start to curl sideways to go to neutral. Then you want to see it get up. And then you want to see price action above it. Something like that where price can hover above it. You know, you start to get volatility contracts a little bit, and then it starts to set itself up for a bounce. The unfortunate thing is in this environment, we typically see bounces that go, you know, especially in bear markets, bounces go way up and then it just comes right back down, and then you get a, you know, big old move up and then a big old move down, and it's just this crazy aggressive type trading environment. If you take a look at the Qs, same thing, right? So we're right there in the where the options market priced in, so nothing crazy. We're just about at the lower range. We tagged it actually today, but just take note, the orange lines is the volatility right here. That's still pricing in. So within just only 2 days left, it's still pricing in just a large amount of volatility. So what do you expect, you know, to see in this environment? Well, let me just tell you this. I've been posting significantly less amount of trade ideas in my daily swing ideas, and the reason is simply because of this. Because of large bouts of volatility. I like to see volatility contract, so when it contracts and I get a good entry, volatility expands in my favor. Versus here, you're basically saying, okay, I'll go along here, but I'll have to put my stop way down here. And that makes sense, you know, if you're a very longer term investor. But if your money gets held up like this, and you know you're risking this, you'd have to be at least trying to earn, you know, back to the all-time high where, you know, it's a 2-to-1, 3-to-1 risk to reward. So your money's going to be tied up there for a longer period of time, and you can't press the limits on the size of that trade because of the amount of volatility in the risk. Okay, and everyone has different trading strategies, right? So I'm just telling you kind of my thought process there. Now look at the 15-minute time frame. Same thing, 5-day moving average, still declining, got rejected, couldn't hold, sold off. What do we need to see? We need to see this flat now. We need to see price get above it, okay? Let's continue on. IWM. IWM literally looks like it's crashing. I think that it's possible that we see a rally. We see, you know, like the RSI, little low to a higher low. This could be capitulation with all that kind of volume. But I mean, the volume has been building on these down days. It doesn't look good. This right now is now into bear market territory. If we do get a bounce, I mean, okay, cool. Come back up to 210, 205. Right now, it's in the middle of what the options market priced in. Tomorrow, I didn't mark it out on this chart, but it's pricing in a $6.41 move for the remainder of the week. So volatility, once again, here even, is still relatively high, okay? Now, let's take a look at the 15-minute time frame. This one did get above it and did hold for a little while for the 5-day moving average, but then it's obviously sold off there towards the Fed meeting. RSI is not quite oversold yet, and the PMO is starting to curl down and trying to head down towards zero. I'm looking at the futures market. It looks like we're going to try to get this gap up, but you know, don't read too much into it. So where can we potentially start to see a bounce stronger? Well, I mean, looking at the 5-day moving average right now, starting to still declining, but it kind of trying to look like the decline steepness is starting to flatten a little bit. So when I look at this chart, I'm looking at this little high, that little high, this high, and this high. So like this 204 to 202 kind of zone in here. Perhaps if we start getting above that, that could be a potential area for a stronger bounce to ensue. But just keep in mind, if it comes from this low right up to here, that's once again a very aggressive move, and very aggressive moves, you need to let those type of things digest. You can't just chase very aggressive moves. Now, for the bullish case, let's look at a couple indicators. So this is where I stated earlier where this is where we get bounces, but this is also where breakdowns occur. So the bullish percent index on the BPNDX is well below 50. It's better to see that above 50, all right? But we do have a positive divergence forming. Now keep in mind, that's also where breakdowns occur, okay? So yes, we got a bullish divergence forming, so a bounce on these very extended levels. By any means, they could bounce. But just understand that volatility is high, once again, okay? So if you are trying to position yourself for a bounce, you need to do so very tactically given this current market environment. Now, if you look at the BPC OMPQ, okay, also bullish divergence, starting to curl up right a little bit here. We're starting to see larger range candles, larger volatility, could be some type of capitulation where we see a bounce. Okay, so the opportunities there intraday, but just be very mindful of the day-to-day or swing or overnight holds here. Okay, BPSPX, same thing, positive divergence. Okay, a low, a lower low, a low, a higher low, positive divergence there. Everything's setting itself up for a potential bounce. Okay, the NASDAQ McClellan oscillator, oversold territory. You typically get bounces there, but keep in mind you've also seen breakdowns occur there. NYSE McClellan oscillator, still oversold. It's where you typically get bounces from. Okay, so as you're starting to see this, it does seem like the market is trying to just hold itself together to see some sort of a bounce. Okay, but the market just got a big announcement. It needs to digest it. We need to see these moving averages start to flatten out on those, the 5-day moving average and price to get above it. And we need to see a proper setup. What I'm basically saying here is it looks like the market could very well bounce, but the risk, but the unfortunate thing is there's a risk of more downside in this type of volatility. So if you want to try to tag the perfect bounce, it seems like we're setting up for that, but this perfect bounce that we're setting up for holds a large amount of risk, okay? Now, a couple other charts here that are very interesting. This is the Cohen high-low. So typically when we get these very low readings, this is 0.05, I marked them out, okay? So right here in 2020, 2019, you can see it tagged a bottom here. The COVID bottom, minus 32%. Here, minus 23%. That was in 2018 to 2019, right? 2016, it caught the bottom of a 20% correction. This was the 2008 correction, financial crisis. It tagged it a bunch of times, so very, very weak, but you can see it tagged this bottom, moved up, tagged this bottom, moved up, tagged this bottom, moved up, tagged this bottom, and then moved up. So obviously there was a lot more volatility there. And as you can see here, coming out from the dot-com bust, it tagged this bottom pretty darn spot on. And in 1999, here it tagged this move to the downside, which was, it doesn't look big on the chart, but it was 24% before it really started to rip up higher. Okay, so this has been pretty good for tagging bottoms. We're not there at this particular point in time, but we're not far off. Okay, so it's something to watch. The next one is this NASDAQ record high percent index. This one is a very powerful tool too, dating back to 1999. We can see here when the blue line crosses down through this 20 reading, this dash line, but then turns back around and crosses up through 35. That is typically where it finds that bottom. Okay, and you can see here, it did that right here. It did that right here, right here, right here, right here. It did that as well. And the reason why I'm showing you this one is because we are now getting a reading at 20.36. So we are right about at 20. Now this is on the weekly time frame, so we don't know where the week's going to close off at. But just be mindful that okay, so if we click down through here and we start turning up through 35, that actually might mark somewhat of a bottom for another rip up. Okay, so I'm trying to look for the bottoms, do our best we can. Another thing that I want to call out that was brought to my attention was some dark pool activity. So somebody from my Discord posted this out, and then I saw the chart. I was like, it was a pretty darn reading. So I brought up the chart, and I looked at this. Okay, this is the DIX. I don't, if you're not familiar with that, it's a dark pool index. But this type of reading is actually pretty bullish. Okay, and we haven't seen this type of reading for 11 months, pretty much since coming out of the pandemic low. Now, this isn't something that you got to put too much weight on by any means, but just put everything together. It does seem to me that, we're trying to find a bottom here we're trying to find a bottom. Unfortunate thing for us though, is volatility is still really, really high here. Okay. Now with the Fed on top of all of that, pulling that punch bowl away from us, it makes it even much more of a difficult environment. So as it stands right now, as we come to the conclusion of this, if you are trading intraday, you should be loving this. If you are, a longer term investor, you probably dislike this, as most of the positions are getting very, very wonky and very, very wacky. You may have, gotten out of some positions too as well. Now, If you are a longer term investor or swing trader, just keep in mind this: volatility will subside eventually. So you just got to weather this storm as of now. You need to be patient, sit on your hands if you don't like this environment, and don't do anything stupid. This game is all about risk and capital preservation. If you cannot preserve your capital, well, somebody else is going to take over that capital. All right, you're going to give it away. So in order to really, once again, be successful during these times, you need to be incredibly patient, and you need to be so focused on risk. And if you're trying to make back your money and you're thinking about it that way, just don't do that. Don't do it. It's a horrible way, because that type of mentality and that type of thought process is going to get you in trouble, especially if you allow your losses to get bigger than bigger than they should be getting bigger than. All right, everybody, that's all I got for you. Hope today's video helped out. See you later.